Welcome to the Explainer. Today, we're diving into a really powerful idea that is completely changing the game for investors: quantitative investing. We're going to forget about gut feelings, market noise, all that stuff. Instead, we'll see how simple, data-driven rules can bring some serious discipline and a real edge to your investment strategy. Let's jump right in.
You ever just feel totally overwhelmed? I mean, you're staring at a market with over 4,000 stocks here in India, and it feels impossible to know where to even begin. Or maybe even worse, you've been there, you sold at the bottom, or you bought at the peak, letting fear or greed get the best of you. Well, these are the exact problems that a systematic, quantitative approach is designed to solve.
So here's our roadmap for today. We'll start by looking at how investing is shifting from an art into more of a science. Then we'll get into the core building blocks of quant. You know, the factors. We'll see them in action with a couple of really famous strategies, and then we'll bring it all home to the Indian market. And most importantly, we'll see how you can combine all this power with traditional analysis.
Okay, so what is this big shift all about? This whole idea of moving from art to science? Well, it's really about moving away from relying on those gut feelings and compelling stories, and instead building a disciplined process, one that's systematic, rules-based, and something you can actually repeat time and time again. Here's the core difference, right here in a nutshell. Traditional investing, it often leans on subjective feelings, on emotion, on a really good story. Quantitative investing, on the other hand, anchors every single decision in objective data and clear mathematical rules. Now, the goal isn't to replace human insight, not at all. It's about giving that insight a powerful, disciplined foundation to stand on. And the advantages of having a rules-based system like this are just huge. First, it takes your emotions right out of the equation. Second, it gives you the power to analyze thousands of stocks at once, something no human could ever do. And crucially, it lets you backtest your strategy. You can essentially travel back in time to see how your rules would have actually performed. This builds a ton of confidence and bakes risk management right into the process from the very start. So how do these systems actually work? What's the secret sauce? Well, it all comes down to something called factors. And honestly, the best way to think about them is like the nutritional labels on your food. They break a stock down into its core measurable characteristics, so you know exactly what you're putting into your portfolio. So instead of looking at every single stock as some unique, one-of-a-kind story, factor investing looks for common, measurable drivers that have historically pushed returns. It's about finding those underlying patterns, like a stock being cheap or being really high quality, that the market has rewarded again and again across hundreds of different companies. And these factors are all based on really simple, intuitive questions. Are we buying a cheap stock? That's the value factor. Is it a really good, profitable business with low debt? That's quality. Is it a stock that's already on a winning streak? That's momentum. Each one of these factors gives us a clear lens to evaluate a company. Okay, so if factors are our building blocks, then you can think of these famous frameworks as the assembly instructions. They're basically proven recipes from some legendary investors, showing us exactly how to combine these factors into powerful, repeatable strategies that actually work. A perfect example of this is Joel Greenblatt's magic formula. It became incredibly famous for its elegant simplicity. I mean, it just combines two of the most powerful factors we know of, quality and value, to find great companies that are selling at bargain prices. The process itself is just brilliantly simple. Step 1, find high-quality companies. So it ranks all the stocks by their return on capital, which is a great way to measure how profitably a company is using its money. Step 2, find cheap companies. It ranks them all by earnings yield, which tells you how much the business earns relative to its price. Then you just combine the two ranks, and boom, you get a list of good companies at cheap prices. Now, another really powerful tool is Joseph Piotrowski's F-score. This was designed to solve a classic investor problem, the dreaded value trap. That's when a stock looks cheap on paper, but in reality, it's just a failing business. The F-score is basically a checklist to help us separate the true bargains from the potential disasters. The F-score works kind of like a 9-point health checkup for a company. It gives out points for positive signals across 3 key areas: profitability, financial health, and efficiency.
A company that scores a high 8 or 9 isn't just cheap. It's a fundamentally strong business that is actually on the right track. So, this all brings us to a really key question. Why is this so important for the Indian market right here, right now? Well, it's because the conditions are absolutely perfect for this kind of systematic approach to give you a real, tangible edge.
The opportunity really starts with the sheer scale. I mean, just look at this. The Indian market has over 4,000 listed companies. Manually trying to analyze that many is just impossible. You pretty much have to use a system to find the hidden gems. You combine that fact with the recent explosion in data accessibility and increasing market efficiency, and you've got the perfect environment for these quant strategies to really shine.
And now we come to what might be the most important takeaway of all. Look, this is not a battle between quant and fundamental investing. It's not one or the other. The real power, the true magic, comes from putting them together, using systematic rules to supercharge your own fundamental analysis. The goal is not to let a computer make every decision for you. It's about using the power of quant to do the heavy lifting. As the source material puts it so well, you should think of it as creating a systematic first-pass filter. It's a way to scan the entire market and just surface the most promising ideas for your own deep, fundamental research. So this 5-step process is a fantastic, practical blueprint for how it all fits together. You start wide, filtering the huge market down to a manageable universe. Then you let your quant model do its thing and rank them. This allows you to focus all of your time and energy, your deep fundamental analysis, on just the top 20%, the most promising candidates. And from that much smaller, high-potential list, you build your final portfolio. This gives you a really practical model for making that final decision. It's not 100% quant, and it's not 100% fundamental. It's a balanced, weighted score. So in this example, the deep fundamental analysis makes up 60% of the decision, but it's still anchored by the discipline and objectivity of that 40% quantitative rank. It really is the best of both worlds. So we'll leave you with this thought. As markets get faster, more complex, and more data-driven, integrating the systematic power of quant with your own analysis isn't just some nice-to-have edge. It's becoming essential for building a robust process. The only real question left is your investment process built for the future? Thanks for watching The Explainer.